the consumer who's going to overpay, in essence, right, does have discretionary income and is not going to be a bad tenant, right? So my point is, if you're at the bottom of the market and you're a mom and pop and you're renting because you're the lowest rents out there, I think you're in trouble. I don't think you have a margin. I think you're at the mercy of the market completely. And there is no spread or margin or safety or pillow, whatever you want to call it.
Especially with rent control.
Right.
Hi, this is Chris German. Welcome back to the Apartment Dealer Show. Today we have a treat for you. Today we have with us Mr. Gil Figueroa. Now, Gil has been in the lending space for more than 3 decades and specializes in commercial loans for multifamily properties that you and I own. And we're going to discuss the dynamics of the market as we have it now. How has lending changed even within the last few months? And what can the information that commercial banks work with, what can the markets tell us about what we may see here in the future when it comes to interest rates, values, and all the rest? So Gil, thanks for being with us.
Thank you, Chris.
Now, of course, you're no stranger to the show. We've been doing educational events together for some time. And we have these get-togethers because every now and then things are changing and evolving. To start us off, I'd like to know how does someone make themselves a good prospect for a commercial loan? Because I get calls from investors who they've stayed in that 2 to 4 unit space because they believe interest rates must be higher on commercial loans. It must be more difficult to get commercial loans. Actually, it's the opposite more times than not. Is it the asset? Is it the investor? How do you become a good candidate for a loan on a multifamily property?
Okay, it's a good question, Chris. It's basically the same in any type of product. So they look at credit, they look at your history, they look at experience, and they look at your personal debt to income ratio. Unlike single family, where they have more stringent factors when it comes to debt and income factors of maybe 43, 45%. Multifamily lenders take more of a global approach and go as high as 80 on debt service. In essence, a 120 debt service on a global approach of the client and all his income and all his liabilities. Another pro for multifamily lending is the ability to do an LLC. So if you're a client and you have a weakness either in credit or maybe net worth or maybe experience, you could always partner up with someone else and create an LLC, where this would not help you on a single family 1 to 4 unit deal.
Right.
You'd have to qualify on your own. So there's a lot of things that you can do to prepare yourself. If you don't have the net worth, maybe an LLC and a partnership works. If you have issues in your credit, then you have to think of maybe another LLC, where maybe you're a minimum partner of the LLC. So there's a lot of different ways. Whereas in single family, you don't have those. As far as rates are concerned, the single family have more of the long-term rates, a 30-year fix, 15-year fix. And the multifamily has a plethora of products, everywhere between short-term, 3-year, 5, 7, 10, 15, and 30. So depending on what the client's objectives are.
Sure.
Yep.
Now, of course, you're a commercial loan broker, meaning you work with many banks. And so if I call you and say, hey, Gil, I'm personally buying a building, you can tell me what the options are across a spectrum of banks, not just what your in-house rate sheet is, because you're limited to one bank, one set of standards. And so to that point, not all banks provide apartment loans. And a lot of them, quite frankly, lie through their teeth and say, oh yeah, we'll do a loan for an apartment. And these are some of the bigger banks. I won't name them, but some of them that you probably have money on deposit with. And that just becomes a nightmare. Versus there's a whole host of banks that you've probably never even heard of. They're not on every street corner, but these are actually the banks that are providing apartment loans. How does the consumer know, though? If they walk into one of these big branches and they meet with the banker and they say, oh, yeah, we'll do a loan for your apartment, and they're going to, tell the prospect, tell the consumer everything they want to hear, how are they to know the difference between that and, say, the products that you have available?
Yeah. The reality is they won't know. They're flying blind, completely blind. Because even in our market, being in the market every day and funding 10, 20, 50 million a month, we're still looking at different situations that change on a dime. So recently, one of our banks that was very competitive ended up warning us that they're going to be uncompetitive. They were going to be completely out of the market and didn't want to really lend in the next month or two. Their coffers were full. There's no way a consumer would know that. Mm-hmm. There's no way a retail loan officer would tell a consumer these integral parts of their business without having a relationship. So the reality is, for us, it's a 24/7 job to know who's lending at what level, who's aggressive for whatever objective it is. So it is basically an impossibility for a consumer to really know and be objectified as far as what he wants to accomplish, and if this said bank is going to do that. And it's not just rates. It's not rates. So I always warn the consumer, be careful what you're shopping for. Because if you're looking for rates, they might not like something in your personal debt ratio or your personal file.
The building. They
or
might
the
not like
building
the
itself. Exactly. And what happens with a lot is the consumer can get in an escrow with a loan officer that's a yes man, and until he goes to the loan committee a month and a half later, and then all of a sudden the product, it doesn't fit the profile because of either the client or the asset or both. And they've wasted a tremendous amount of time and money on an escrow they can't close. So the answer to that is the consumer really needs a strong mortgage broker who's in the business on a daily event, funding loans, solving problems, and knowing exactly who can do what.
Well, and the strength of the lender means a lot to does the buyer get the property? Because, again, taking off my investor hat, putting on my broker hat, the last thing we want to see is a loan contingency and appraisal contingency, especially how the market is right now, right? It's very competitive, a lot of money in the system. And so if we see a purchase agreement come in that has a loan contingency and it's long drawn out, and an appraisal contingency, and we quiz the buyer and quiz the lender, and we're not confident that they're going to perform, that's one of the things that we're going to convey to the seller. That, hey, maybe it is a full price offer, but we, at the end of the day, we don't think it's going to close because of either the bank involved, the loan broker involved, and so forth. So it definitely is a hinge point. And if you want to be competitive and write an offer, you probably should remove your loan contingency and appraisal contingency. And depending on where you are in the country and you hear that, maybe that's not the norm. But here in Southern California, to compete for multifamily, that may be something you have to consider. And you should feel okay doing it. And maybe Gil, correct me. But if you're confident in your lender that if they've given you a product, they're going to perform. They're known to close. They don't tell you a sob story after X amount of days, like you mentioned. And the asset you're buying, you should know whether or not it's going to appraise. And maybe if you feel you're unsure, the agent who's representing you to purchase the building should be able to tell you, yes, for sure it's going to appraise. Here's the comps, here's why. Or, no, we might come in a little bit under, so be prepared with this X amount of additional cash. But in either case, it shouldn't be an unknown. Do I have that right, wrong?
No, absolutely. I mean, again, in this competitive market, you need to be prepared. If you're not pre-approved or at least preset with a lender that you've talked to, has an idea that you as a consumer won't be a credit problem, number one. And then obviously the building, is it going to fit that lender's criteria? What's the grade on the building? What's the quality, conditions? How many tenants are not paying? There's so many factors now that we have to look at, because there's definitely a difference in the lending per bank of what they look at and what their limits are. Right.
And so you said, quality of assets. So obviously we're in a transitioning market. We have some headwinds that's coming at real estate, both residential and commercial. When we talk about the class of an asset, A, B, or C, typically we start off by talking about the location, of course. And then we're also talking about the quality of the building itself. Given that interest rates are on the rise, given that the lenders are getting a little bit tighter, is there a difference between the products for an A building, which means a nicer area, per capita, it's higher in these areas, versus a C type building that's in a mom and pop kind of bread and butter neighborhood? Are the loans offered different?
Some lenders don't even lend out of the spectrum. So unless they're in San Bernardino, Riverside, Orange County, LA County, they really won't even lend. So there's some lenders that are very aggressive towards certain areas and very non-aggressive in other areas. With that being said, the market's changed. As we know, the Riverside San Bernardino market's done pretty good in the last 24 months. So that's not looked at as negatively with some lenders, and that's improved. I think some lenders are even considering that to be a better program now. Instead of C, maybe even bumping it to B, just because of the incomes and the flow of cash in those areas. So things are changing. And some LA areas have been really injured, where before LA was gold and maybe not so much anymore. So it's changed, but very slightly. There's still parameters that banks look at in their lending criteria. Typically, the higher the grade, the higher the loan to value, and the lower the debt service to qualify. So if you get in the outskirts, you might have lenders that'll lend, but maybe at a 130 or 135 debt service versus 120
Hedge
or
the risk.
115. Right. So it just really depends on that. It hasn't really changed much. Yeah.
Now, of course, I'm making my rounds interviewing those of us that are involved in our upcoming educational event, and there's much talk about interest rates and what impact, if any, that's going to have on the market. Before we discuss impact on values, it's easy to discuss the impact on cash flow, because obviously if interest rates go up, the debt's costing you more money. That means your cash flow takes a hit. But maybe if you can explain for the viewer that correlation between the interest rates rising and essentially their net income on a multifamily building they're looking to purchase.
Sure, it's real simple. So if the rates go up, in essence, the building won't debt service with the same amount of down payment. You're going to require more. For example, on a $2 million transaction at 3.5, you were able to basically borrow $2 million at a 120 debt service. Well, at 3.9, for an example, that drops to $1.9 million. So you'd lose $100,000 right off the bat in buying power. If it was a $4 million deal, you'd lose 20%. So that's $200,000. So in essence, there is a drop, a substantial drop. So more than ever, you really have to analyze the building correctly based on today's market and have an idea of what your objectives are if you can meet that criteria. The market's volatile. The rates are moving. There's some lenders that have moved out of the market per se, and they're being a little more cautious. And there's some lenders that have taken that opportunity to be more aggressive, to get in the market. Like we're refinancing your deal right now,
right,
and we found a fantastic rate, much under most of the market. Right. So that's a perfect example of what a mortgage broker can do to find that flow of who's really lending, who's aggressive, who's willing to offer a better term. But overall,
and it impacts the cash flow. And I think that's I know people have different positions on why they own multifamily properties, but if you own here in Southern California and you're subject to rent control and the politics and the moratoriums and everything else, in my opinion, there better be cash flow at the end of the tunnel, because if not, then it's not worth the time, the risk, the headaches, and the rest of it. And so as interest rates rise, the ratio is something like if we pop the interest rates up by 1%, your net income can drop by 15%. I mean, that's a significant change in your net income. And to your point, so not only is my cash flow going to go down potentially with these rising rates, I'm going to have to put more money in the deal if values don't change.
Exactly.
Because of debt coverage, I'm not going to get as much loan dollars.
Right, exactly. So unless values drop, you're putting more money down as far as percentages.
So then when we move to values, right, because me and Bruce Norris had this conversation, and he brings up the point that it's not true historically that every time there's higher rates, values decline, right? So and so you have to concede that he's got, hit the charts. He always refers to the charts. He's a charts guy, and that's why I like Bruce. This go around, interest rates are obviously trending upwards, jolted the stock market today because there's, we're talking rates. We just said that for a 1% increase in rate can drop your cash flow by 15%. what do you think that's going to mean to values, apartment values here locally at the end of the day?
You know, if you would ask me this 6 months ago, I would have said logic portends that we're going to have a softening, right? I think I've changed my stance on that because of flow of money flow. And what I mean by that is there's so much turmoil globally that we're not taking into consideration how much money is flowing into our asset base now. Right now. I mean, so you have European money because of the Ukrainian war. You have Ukraine, who knows, you know,
Canada and the nonsense.
Canada, the nonsense in Canada. Anybody who got their bank account locked in is definitely moving that bank account. So there's going to be a lot of flow coming into America, per se, I believe. You know, in the last decade, the three big countries that took on more millionaires than anywhere else was Australia, U.S., and Canada. Well, two of those outside of the U.S. during COVID really showed us some different colors of what their attitude was towards the average person's rights. So I think that's going to weigh a lot. And I think this equation of new capital flow in America is something that I don't think we've ever seen to this extent. You know, so there's a lot of new money.
So the money is looking for a safe haven. America's assets, real estate is a safe haven, and because of that, could curtail a softening that we should see. We should see a softening, but it might curtail it because supply and demand. If they're looking, they may take a lower rate of return because they're happy just to have it in a tangible.
Well, even if there's no return, is it better than a bank account that's locked? It can't be used. I mean, so I think cap rates are going to be could be something of a factor that won't be used. You know, we have to think of European markets, of real estate markets out there where, you know, the market's never made any sense. Why would somebody be buying these properties?
Or New York real estate.
Or New York real estate per se. Yeah. So my point is that without the capital flow, the logic answer would be, yeah, there could be a softening, right? If our buyer pool remains exactly the same, that always wants a spread between cap rate and interest rate, right? And if that buyer pool stays and is the only buyer pool, then logically it has to drop because math doesn't lie. So it has to drop. But if a new buyer pool comes in, that metric is not the reason to buy. So in other words, if they fear maybe sovereignty in their countries or they fear inflation more than buying overpriced assets, then, you know, who's to say where the market goes?
Supply and demand.
Supply and
the
demand.
The building's worth whatever somebody's willing to pay at the end of the day.
Absolutely, absolutely. And the fact that your homeowner, your average middle class homeowner, is maybe being locked out of ownership only improves what? The tenant base.
Right.
So maybe we're having a more middle-class tenant base than we thought we'd ever have in America. Maybe that's the new flow of cash coming. I wouldn't doubt that.
Well, and that's what I've pointed to. So we recorded a few videos to this point on, what impact does interest rates have into the market. And I don't have a crystal ball, but what I've said is pay attention to the rental rates, right? Because if the rental rates can continue to climb, then they're going to hedge us against this increase in rate because we're going to have more cash flow and so forth, then the cap rate will still stay intact. But if you squeeze people with inflation where we're headed now, next question here, then I think that gets a little bit tougher to raise rents unless we get a new type of tenant, right? That has more discretionary income. So a lot of these things, of course, are in flux, and this is what we're going to roundtable at our educational event to get, what I believe to be the brightest minds in the business together to say, okay, yes, maybe we don't have a crystal ball, but here's some indicators we need to pay attention to. Here's some things that we can watch. Now, interestingly enough, probably now for the last 3 or 4 years running, you've been able to pinpoint either an increase or decrease in rates and in interest rates following our educational events. So I'm hoping you'll have something for us on stage, come here in a couple of weeks in terms of where rates are headed. But obviously, the overall trend is for the last 3 decades, rates have been falling. We're probably on an upward swing now because there's so much money in the system. What about this talk about a recession, right? Inverted yield curve and all the other indicators. What should landlords be cognizant of as we're looking at the economy right now?
Well, let me bring the inverted yield curve to a layman's conversation. Sure. It's very simple. So if you take, for instance, the 2-year Treasury versus the 10-year Treasury, the 2 years being, 2.25, and the 10-year being 2.5 or 2.6. So that margin is very thin. Those are thin slices. So that's in essence an inverted yield curve, or where the rates should be. So there should be a greater margin between a 2-year and the 10-year.
So let me stop you.
Yeah.
So again, because up until the last couple of years, I really didn't understand this either. So is it fair to say that the 10-year rate increases as people become they're less bullish about the immediate market, right? So there's greater demand for the 10-year T-bill. Is that what it is? And then the 2-year bill has less demand because people aren't as bullish today. They're looking at it more long term.
That could be a factor, and I think it was a factor for many times that, and this is just an indicator. So in other words, there's different things that go into consideration to call a recession. Now, I'm not an economist, and Deutsche Bank has just called out a potential recession because of the inverted yield curve for 2023. So I'm sure their economists are much better than what I can come in. But my point is this. We've never been in this environment before with so much cash. We're not taking into consideration all the cash that's been either printed or made during, the last couple of years. I mean, it's tremendous. It's tremendous. There's more millionaires and billionaires on the planet than ever before. Okay, there's the millennials that have become crypto millionaires and maybe even billionaires. So that's a whole flow in the last 2 years of over 4,000% increases that they've had. So that money competes. That money competes for what? Items, right? For cars and for real estate.
Too much money chasing too few items.
Right. Yeah. So that being said, the inverted yield curve goes away if our treasuries jump to 4, and our 10-year treasury jumps to 4, and our short term stay at 2. So then we have what? A healthy yield curve. Okay, and no one can say that won't happen. And at the progress that what the rates are doing, what the Fed has in mind is exactly that. Okay, so they're trying to make a yield curve that is normal and not inverted by continually raising rates. Okay, will it work? I don't know. We've never been in this environment before, and I know everybody likes to look at charts, and I love charts, and I live and die by them as far as quoting our rates and so forth. But this is an unprecedented time where there is so much capital and debt, right? So we have interesting times that, frankly, out of my pay grade to really analyze. But these are completely different times, and my take on it is we're going to have. See, a recession would mean deflation, right? And I don't think we're going to see that. I think what I'm seeing is more of a stagnation economy, where we have stagnant economy, not much GDP, and we still have inflation because there's enough money flow to keep those assets in demand. So I'll ask you a question. In the last 2 years with the lowest rates on the planet that we've had, since, who knows, a couple hundred years, how many deals have been bought cash?
There's still plenty of cash.
Percentage-wise?
Cash to those taking loans, probably 60-40.
So these weren't people chasing rates, were they?
No.
They didn't care about the rate. The rate could have been 2 or 20. They would have still bought. Yeah. So,
and I don't know if that's something particular to the markets that we work, the geographics, but yeah, there's plenty of, on the buyer's end, cash and optimism, even as we record this.
Yeah, and I think what I'm seeing, this leads, to other questions, but what I'm seeing is the bigger, players are more afraid of inflation than buying an overpriced asset. And as long as that continues, it continues.
And so let's talk about bigger players. So when we talk bigger players, again, typically we're talking about, in the multifamily world, those individuals that own a lot of doors, right? Probably 100 doors or more. And you and I, versus I would say the other speakers that are involved in our event, are a little closer to our clients in the sense that we get more wrapped up in their stories and in the day-to-day and helping them grow, or whatever it is their obstacle is, and we get more involved in that process of helping them overcome that and then continue on to the path of what I call a financial legacy. I'm curious from your vantage point. So as you work with these investors, the successful versus, say, we'll use the word average, not derogatory, but just the average mom and pop investor, they might own 1 5-unit building, maybe 2, a 5-unit and a 6-unit, but there's definitely a disparity between them and, say, the larger players, as you mentioned. What's the difference in the thought process between the two? I mean, when these two investors look themselves in the mirror, what's the difference in the self-talk in terms of why the successful guys are probably active as ever right now, and mom and pop are, more anxious, obviously, because they see food going up by 30% and everything else. What have the two groups shared with you, and again, in the conversations with them, what makes them different?
It's all about playing offense versus defense. And I think the large investors always playing offense, and they play a lot of offense. And what I mean by that is they always have a value add program. And that's what their thinking is. And what they're thinking is they can keep up with all the flaws of the economy, all the issues, everything else, as long as there's a big spread in their value add component. So the one thing you've done before that I think is just phenomenal, and that's, over improve a unit in the area and have the best unit in the area. And I'll tell you, there's a lot of value to that, because the consumer who's going to overpay, in essence, right, does have discretionary income. And is not going to be a bad tenant, right? So my point is, if you're at the bottom of the market and you're a mom and pop and you're renting because you're the lowest rents out there, I think you're in trouble. I don't think you have a margin. I think you're at the mercy of the market completely. And there is no spread or margin or safety or pillow, whatever you want to call it.
Especially with rent control.
Right. Yeah. So, and another factor we're not looking at right now is not only are interest rates going up, rehab's going up and taking longer. Right. So that's another component, where expenses could have been, XYZ percentage. Well, not anymore, not reality. I mean, what has rehab gone up? 10, 20%?
Oh, yeah. Easily 20.
Right, 20%. And then there's also the lack of what? Ability for labor, right? So we have multiple streams of issues coming into play. And unless you're playing I'll call it a value add game with enough spread and margin to handle these substantial issues in the marketplace, you're going to be in trouble.
And one of the things I'm going to tackle at the event is, for those individuals that are, they're sunsetting on their investments given their age, that strategy that made them self-made millionaires is not going to work for the children. It's a difference with rent control now in place and everything else. The strategy has to change in terms of tenancy, quality of units, and the rest, because it's not going to work anymore. Essentially, if you go back to basics where, hey, let's just keep the units real average and rent to the lowest rental rate and increase our cash flow by not putting any money into the asset. That's how we actually increase our cash flow. Those days are gone because of the different things that we see.
Yeah, and that in a way is playing defense, isn't it? That in a way is playing defense, saving your dollars versus reinvesting them to improve your product. So I think that has a bad edge in this market. I think there's enough smart money out there that's looking for value add, that's not afraid to pay tenants off to redo the building or buy a building that's empty and redo it from ground floor. I think there's enough money out there that's competing for that type of tenant base that really is your safe tenant base, that they're going to be in trouble eventually, because they're going to end up with what? The cheaper rents and the cheaper tenants.
And costs are going to eat
and
them
more
alive.
issues, and costs to eat them alive.
Costs will eat them alive.
So that's what people need to look at. Costs are going up, rates are going up. So your margins of error are very thin. Okay. So if your game plan is just to survive, I think you have a problem. I think you either need to cash out, refi, have some extra money available either to diversify in other products, or have a game plan for your value add in this building. And if your building doesn't appropriate itself to value add, maybe it's time to sell and look at something that has a value add component.
Right, that you have that opportunity.
Right, so you have that opportunity. But I think playing defense and standing still and deer in the headlights never do well.
Well, there's a lot to talk about at this year's event. I mean, there always is, but again, like you said, a lot of these things are unprecedented. And so how do you deal with the unprecedented? So we look forward to having you. We thank you for your time now. I know that the viewers appreciate your insight. So thank you again.
Thank you, Chris.
And so we have it. The market is evolving and changing. So there's never been a greater time for you to have the resources, information, and the network of professionals that can be at your side to help you not only navigate these waters, but to help you navigate and continue to build your financial legacy in multifamily properties. Until next time, this is Chris German wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. See you then.